Nvidia is the most valuable company on earth. Last year, it put billions of dollars into the companies that buy its chips. Then it booked what they spent as revenue. Not one of those transactions was illegal. Every 3 months, Nvidia files a document with the Securities and Exchange Commission. It runs to 100 pages. Almost nobody reads past the headline number. Deep inside the last one, there is a section called Customer Concentration. It lists the buyer who account for more than 10% of the company's sales. For the quarter ending in October 2025, there were 4 of them: 22%, 15%, 13%, 11%, 61% of the $57 billion in a single quarter from 4 buyers. A year earlier, the same section listed 3 customers at roughly 12% each, 36%. So in 12 months, Nvidia went from a third of its revenue resting on the 3 companies to nearly 2/3 resting on 4. The filing does not name them. It calls them Customer A, Customer B, Customer C, Customer D, which leaves the one question the document does not answer. Who are they? And where is their money coming from? One of the largest buyers of Nvidia chips is a company you have probably never heard of. It is called CoreWeave. A few years ago, it was mining cryptocurrency. Today, it rents out graphics cards by the hour. And its business is real. In the quarter ending June 13th, 2026, CoreWeave reported $2.5 billion in revenue. It is up 112% in a year. Its order book stands at around $104 billion. Those are not soft numbers. They are audited and they are enormous. But there is a second document. In September 2025, Nvidia and CoreWeave signed a new order form. It sat under a master agreement the 2 companies had already had since April 2023, no longer immaterial. CoreWeave had to tell the regulator why it was disclosing this one now, because the agreement it wrote was no longer immaterial. It is a take-or-pay capacity backstop, $6.3 billion, running through April 2032. Here is what it does. If CoreWeave cannot find customer for its computing capacity, Nvidia buys that capacity itself. The company selling the chips was promised to rent back whatever the buyers failed to sell. Nvidia also owns part of CoreWeave, 11.5% of its Class A stock. According to a filing from March, in the 3 months before that, it had almost doubled the stake. So when CoreWeave reports $104 billion of future business, that number is true. And some part of it is it's a promise from the company that sold it the hardware. Nobody has broken a rule here. Every one of these agreements is disclosed in public on a government website. Same pattern exists at a scale that is hard to picture. In September 2025, Nvidia and OpenAI announced a letter of intent. Nvidia would invest up to $100 billion as OpenAI deployed 10 gigawatts of Nvidia systems. Money out, hardware back. It did not happen that way. On February 27, 2026, OpenAI closed the largest private funding round in history, $110 billion, at a valuation of $730 billion. 4 months earlier, it had been worth 500. Nvidia's share of that round was 30 billion, less than a third of what had been announced 5 months before. Amazon put in 50. SoftBank put in 30. So the chip supplier was not even the largest baker of its own biggest customer. But look at what changed shape. The 100 billion was a commitment to build infrastructure. The 30 billions is equity. Nvidia now owns a piece of OpenAI. And in exchange, OpenAI receives 3 gigawatts of dedicated inference capacity and 2 gigawatts of training on Nvidia's next generation systems. A commitment became a shared holding, and the shared holding came back as orders. Then the structure grew again. In August 2026, a group including Apollo, Blackstone, BlackRock, Brookfield, Goldman Sachs, and KKR committed to raise $500 billion for AI infrastructure. This one is different. Those firms are underwriting with other people's money, not Nvidia's. Nvidia is expected to provide residual value support of up to 25% on some projects, which means the risk has not gone away. It moved off a chip maker's balance sheet and onto pension funds and insurers. Off a chip maker's balance sheet and onto pension funds and insurers. So follow the same dollar. It leaves Nvidia as an investment. It arrives at a lab as funding. It comes back to Nvidia as revenue. On the way, it passes through a cloud company where it is recorded as backlog. $1, 3 sets of books, every entry accurate. This is the part that usually gets missed. The AI bubble, if that is what this is. It's not a bubble of enthusiasm. It's a bubble of accounting. Nobody is lying. Every transaction here is legal, disclosed, and rational on its own terms. Nvidia has real reason to secure its supply chain. CoreWeave has real customers. OpenAI has real users. Every one of these decisions makes sense by itself. It is only when you add them up that you get number describing demand that exists once and has been counted 3 times. A bubble of enthusiasm deflates when people change their minds. A bubble of accounting holds for exactly as long as nobody needs to be paid at the same time.